Now we spoke about the fact that, the taxation of interest under the domestic tax laws of the source state can be reduced if the person who's receiving the money is a beneficial owner, right? I mean, beneficial ownership is one of the conditions. There were others as well. But what does this beneficial ownership actually means? Beneficial ownership means that, first thing is you are the legal owner of the interest income. So therefore, there has to be a legal documentation for the loan that has been given. And under those documentation, the party who's receiving the interest should be mentioned there. Now, just by mentioning that you're the beneficial owner, you do not become one. So what are some of the additional things that needs to be looked at? The right to use and enjoy interest in an unconstrained manner. It should not be that once you receive the interest, you have to hand over that to someone else or a large part of it to someone else, right? Of course, if you've done your own set of borrowing, you might be liable to pay interest, but it should not be that effectively what is left with you is not even worth considering that you were actually the owner. You were just a conduit. The beneficial ownership has to be seen in the context of interest and not the debt, right? Maybe a debt was belonging to someone else. He gave it to an intermediate company, right? Which then in turn gave it to someone else. That is not relevant. Who owns the ultimate money? That's not relevant. But who's enjoying the benefit of the interest is what is to be looked at. If you're interposing a beneficial owner by a third contracting state owner, and the idea is to get the benefit of this interest, then these provisions of reduced taxation do not apply. And of course, the facts and circumstances have to be looked at to see who is the beneficial owner, right? So whether this beneficial ownership is available to a conduit entity, the answer to that is a no. And we will just look at what a conduit entity is. To an agent or a nominee, the answer is again no, right? Except in one case where a possibility of this may arise. Think of a situation that there is a foreign company in United States. There is an Indian company in India, right? This Indian company makes over the interest payment to an agent of this foreign company who is also a tax resident of US. In such a case, there may be a possibility that the provision of India-US treaty may apply, right? Let's look at a conduit case. Suppose there's a foreign company which is getting some interest income from the Indian company. Let's say this is $100, right? There's another company X which is in a different state, a third state, and the payment of interest which F1 receives from ICO, it is just passing on this $100 as it is to X. In such a case, if F1 is a conduit company, it cannot be a beneficial owner. Why? Because it was always receiving this money on behalf of X, right? And hence it will not be allowed to enjoy preferential treatment. There are obviously a lot of disadvantages of gross taxation, particularly in the case of bank or institutions which are engaged into lending of money. Let's look at this example. Suppose there is a lender. He's given a loan of $100 to F1, right? At an interest rate of 10%, right? F1 further gave this same $100 to an Indian company, but at 11%, right? If in India, the withholding tax rate is 10%, the quantum of withholding tax interest will be 10% of 11%, which is $11 or $1.10, right? How much was the profit which F1 was making? It was making 11% of 100, which is $11, minus the interest which it was paying to the lender, which was $10. So it was making a profit of $1, right? But if the withholding tax in India is $1.1, then this entire business proposition goes for a toss. And that's the disadvantage that you have for a gross basis of taxation. So even though the net profit of F1 would be minimal, tax withheld in source state at gross basis would distort things for F1, make the business model unviable. In such a case, therefore, generally what the banks insist is that whatever is the withholding tax in the source state, that has to be borne by the Indian company. So the bank may come back and say, the net amount that you pay to me after deduction of this interest will be $11. Anything that you have to do, whether you have to gross up, whether you have to do the deduction, all that should be to your account.